So we've got a whole host of banks coming up. Let's talk a little bit about some of the big ones like Wells Fargo, JP Morgan as well. JP Morgan, solid performance at their consumer unit. Investment banking, though, not so.
Well, I think that's what you can expect to see for the rest of the earnings season. In other words, the traditional banking business in the United States is actually doing really well. Loans are growing at an above-average pace. Interest rates did go up in December, which means that margins are going to be higher, and loan losses, other than what you have in the oil sector, are going to be relatively low. On the other side, everything that's going on in the capital markets business is not doing well. Trading is very weak, investment banking is weak, and asset management is not doing weak. I think looking forward for the remainder of the year, you should expect to see that traditional banking will continue to do well, which means regional banks will do well, and it's a toss-up concerning what's going to happen in the capital markets arena.
So this spills over. This isn't just about JP Morgan then. I mean, you say, I note in your note on JP Morgan, you say there's a general panic concerning bank stocks and that the capital market weakness definitely is there, as you just said. But this is across the board then.
Yes, it absolutely is. And I think that to say that JP Morgan beat its estimate is a little bit of a stretch at this point, because every analyst, myself included, were in a race to get the lowest number out concerning what JP Morgan, Goldman Sachs, Morgan Stanley, Bank of America, et cetera, would do in this quarter. So if they didn't beat the estimates, it would have been perhaps a little bit more surprising.
How about loan losses? Are we still looking at increases in loan losses?
Absolutely. I think that loan losses in the American banking industry for the last 3 years have been well below normal. I mean, in fact, in the third quarter of 2013, they were the lowest as a percentage of loans in the history of the numbers. So it would have been irrational to assume that they were going to stay at that level. So I think you should expect to see loan losses rise in, we'll say, 4 specific areas. One would be oil and gas. A second will be metals and mining. A third would be subprime auto lending. A fourth would be, commercial real estate. And this last one, commercial real estate, is where the biggest hit is going to come from. However, having said that, there's enough revenue coming from the other activities of the bank to absorb these loan losses. But I think for the next 2 to 3 years, you can expect to see loan losses go up in the American banking industry.
So today we've got Bank of America, BlackRock, Wells Fargo. Tomorrow we've got Citi. Which ones of these is the one that sticks out? Is there one where there's value to be found and where I might want to get back in?
Well, I think in the case of both Citi and Bank of America, you have two companies which are selling at 35 to 40% discounts to book value, which is, in my view, absurd. I think these stocks are unbelievably attractive, and I think that both stocks over the next 18 to 24 months should be able to double. So I think that despite what is a sloppy and undesirable quarter, that both these stocks should be bought.